I think it's kind of two main factors here driving gold prices. I think it's kind of a call on the poor fiscal and monetary policy that we've seen over the last few months, but also years. I mean, when you look long term, Nixon closed the gold window in 1971, and since then, gold's had a 93% rough correlation to total federal debt outstanding. So it's on a long-term trajectory up. Secondly, I think, still geopolitical tensions are still rising. We've seen a lot of central banks continue to accumulate gold over the last, years and even recent months. It's still climbing. So I think people are seeing that, they want to join in on what these central banks are doing and diversify some of their assets. You just play the long-term game and allocate. What we do at OCM is we recommend allocating some portion to gold in your portfolio. But then if you want to get leverage on that, you play the gold miners who are seeing historic margins here. You look at what gold miners have been reporting over the last few weeks. It's all record cash flows, record margins, record earning per share. So that's, if you're looking to play the gold market, that's obviously one way to do so. I think you split some of your portfolio into, you could go physical and you go buy from bullion shop and go do that. I mean, Costco sells gold, right? You can buy it on the ETF GDX, which has seen a 57% rise this year. But then if you want to play the miners who are a leverage play on gold, who has seen, the GDX, which is the gold miners index, has been a roughly 120-something% return this year. Wow. That index has seen $3 billion of outflows over a 1-year period. So if you're looking for opportunity, I think that screams it, in my personal opinion. And that's the way we're doing it. And I think you play along from the majors who produce the most gold over 1 million to, I think, all the way down to the explorers. But you have to tread lightly in those areas because there's a lot of landmines as well in the gold industry.